G'day, Anna. Thanks for the comment. I've got my Sunday farm attire on because I'm doing chores around the house. So let me give you a couple of tips of what you could be doing to minimize tax. Now, this is general advice. Make sure that you go get professional advice before you implement any of these strategies because they do depend on the specifics of your current situation. So let's get stuck in. So you've already mentioned superannuation, which is a fantastic strategy. In my opinion, it is the most tax-effective way for you to build wealth for retirement, being once you reach preservation age, which is 60 plus if you retire, or 65, irrespective of whether you are working or not. Now, the ways that we get money into superannuation is through a salary sacrifice, or what's referred to as a concessional contribution. So you have the ability to contribute up to $27,500 a year to your superannuation and claim a full tax deduction on those contributions, essentially meaning that compared to your marginal tax rate, which for most people is between 30%, and for some people who are earning kind of 180 grand plus, 46 cents in the dollar, it is 15% tax on those contributions. So there's a significant change on the taxation on those contributions. Now, a little known strategy is called the catch-up contribution. So if you haven't contributed to those concessional contribution caps to their the fullest limit in the last 5 years, and your balance is under $500,000, you have the ability to use those unused concessional caps for those last 5 years in what's called a catch-up contribution strategy. Now, we utilize this for many of our clients when they've got a capital gains tax event. Let's say, for example, they've got an investment property that for one reason or another they're deciding to sell. In the year that we sell that investment, we normally use the catch-up concessional contributions in order to get more money into super and then reduce their overall tax considerations. So it's a really great strategy. Now, the other one that many people can consider is the downsizer contribution. So as you get towards retirement, you have the ability to sell down your home, get money into super that doesn't contribute towards your contribution caps, and it could be a great way to play catch up if you don't have a significant balance heading into retirement and you are looking to downsize your home. There are eligibility criteria, which I can get into in another video if you are interested, not sure of your age. The next one that we need to consider is non-concessional contributions. So we can put money in after-tax dollars. So this is money that you've earned, you've paid tax on, you decide to put into super. And the thing about that is that there's no immediate tax incentive on the contributions. However, because it is now in a low tax environment, being that any earnings that portfolio creates will only get taxed at between 10 and 15%, that is going to be substantially better taxation than if you were building wealth in your own name. The big thing to be mindful of all of these superannuation strategies is that the earliest age you can get access to them is 60. So if you have a long way to go, so say, for example, I'm 34, I'm not prioritizing my superannuation. I put in the 11%, and I do so on all of my income. It gets me pretty close to the concessional caps, but I don't do anything else because it's just too far away for me to consider putting any extra money into super. So outside of super, the next strategy that we can consider in terms of tax-effective investing is what's called an investment bond. If you're interested, flick me a note and I've got an ebook that runs you through a crash course on how an investment bond works. So an investment bond has been around for a very, very long time, and it's actually covered under the Insurance Act. It's an insurance policy, but essentially what it is it's a tax structure for investment. The benefits of it is that, similar to the non-concessional contributions, you put money into an investment bond in after-tax dollars. However, unlike superannuation, it's not preserved, so you can access it at any time. There are some benefits if you wait for a certain amount of time, which I'll get into shortly. Now, inside the investment bond, it has a flat rate of tax of 30%. So if you're in a higher average tax bracket, so if you're a high income earner, let's say you're earning 200 grand a year, an investment bond is a phenomenal way for you to invest, similar to if you'd set up a company without any of the compliance costs associated with running a company and tax returns and financial statements. The second biggest benefit is that if you hold the investment bond for more than 10 years, it becomes capital gains tax free, meaning that essentially equivalent to if you'd own that in your own name, you may be up for 25% CGT if you'd held that investment and then sold it, whereas in the investment bond, you don't pay any capital gains tax. There is one limitation, is a rule that's called the 125% rule, which basically means that you can only put in 125% into the bond of what you'd put in the full previous year. So for example, in year one, let's say you put in $1,000, year two, you can put $1,250. If in year three you put zero, in year four you can't put anything because 125% of zero is zero, right? So the idea of this this is that we need to contribute to this strategy on a regular basis. The reason why this rule exists is because they don't want people getting to like year 9, dumping millions of dollars into the investment bond, having all of that basically CGT free moving forwards. That's kind of the little loophole that you just need to be mindful of. The other great thing about an investment bond is that you can transfer ownership of the investment bond without triggering capital gains tax, without triggering any stamp duty implications, and without resetting the 10-year rule. So for many of our clients, they build this up over their kids' childhood. They use it as either an education fund or to buy their first home or whatever that might be. Then when the kids get to a certain age, let's say 20 or 21 or 25, depending on when they're responsible, they can then transfer the ownership of the bond into the kids' names. They can continue contributing to it, and then they can continue to run it for however long they like. So it's a phenomenal strategy. Now, the other strategy that we need to consider is capital gains investing. What we've got to realise here, guys, is that investing for income is some cases some of the worst tax efficient investing that we can. The only exception to that is if we're investing in companies that pay fully franked dividends, meaning they've already paid 30% tax. However, the big consideration is that income is taxed in the financial year it is received, irrespective of what you choose to do with it. So if you don't need that passive income and you're just going to go and reinvest it, you're losing at least 30% of that every single year in terms of income tax, right? Capital gains, particularly unrealized capital gains, meaning that you've bought a property or you bought an asset, it's appreciated in value and you keep it, is not taxed. And that means that you can roll over 100% of that investment value each and every single year. And particularly in the context of property, you can go get a loan, you can release equity, and then use that equity to go and buy more properties that then appreciate in value. And this is one of the reasons why property investors who accumulate substantial properties do so well, is because they can roll over all of their gains, they can use those gains with debt, and debt is not taxed, and then they can use that debt to then accumulate more assets. So here's a crash course on the most tax-effective ways to invest and some of the considerations. As I mentioned, it's important to get advice because all of these tax strategies are dependent on your personal income, the types of income you're receiving, and the stage of life that you're at. So if you've got any questions, feel free to hit me up, shoot me a DM. Love to have a conversation and see how we can help.